a mortgage invented in a crisis-built modern America. It promised fixed payments for 30 years and endless suburbs. Today, the same rule is freezing the housing market. Is the 30-year mortgage about to break your plans? Stay with me. We will decode how the 30-year mortgage was born. We will see how it travels through Wall Street every month. We will map why it now locks owners in place. By the end, you will know the levers that actually move payments and prices. Before the 30-year, mortgages were brutal balloon loans. Most loans lasted 3 to 5 years, and then everything came due. People rolled the debt again and again in good times. Then, the Great Depression hit and refinancing died overnight. Foreclosures spiked and banks failed across the map. Washington responded with design, not slogans. The New Deal created federal insurance for mortgage through the FHA, insurance, reduced lender risk, and set strict loan standards. Loans stretched longer, and payments became fully amortizing. You paid a bit of principal each month, and the balance fell. Fannie may arrive to buy loans from banks and free up capital. Liquidity returned, and credit reached more towns and cities. After World War II, the model scaled nationwide. Veterans used VA benefits, and young families found predictable payments. A policy design built homeownership like highways built travel. Now, see what actually happens to your payment after closing. Your loan rarely sits on your lender's shelf for long. Fannie, Freddie, or Ginnie bundle similar loans into mortgage bonds. Investors buy those bonds and receive your principal and interest. Your payment became a cash flow that trades worldwide. Here is the twist that shapes everything today. American mortgages give you a free prepayment option. If rates fall, you can refinance and investors get paid back early. If rates rise, you stay put and investors are stuck longer. That option risk changes how bonds are priced and funded. In the post-war boom, predictable payments built predictable lives. Builders planned subdivisions around the 30-year standard. Lenders priced risk from a common rulebook. Homeownership climbed toward record highs across decades. Now flip the calendar to the recent rate shock. Millions locked into ultra-low mortgage during the easy money era. 2% and 3% rates felt like magic. Then, the Federal Reserve raised rates fast to fight inflation. New loans priced at 6, 7, or even 8%. Owners compared the old payment to the new payment and froze. Selling meant giving up a cheap loan for a costly one. Inventory shrank because fewer people listed their homes. Fewer listings meant bidding wars on the few homes available. The design that built America began to jam the market. Here is the math that hurts. A $300,000 loan at 3% costs about $1,260 per month for principal and interest. The same loan at 7% costs about $2,000 per month. That is a jump of hundreds of dollars every month. Buyers feel it, and owners see it, and everyone hesitates. Could the 30-year mortgage actually change? Ending it is unlikely because voters and lenders love certainty. But pressure is real when rates swing and prepayments vanish. Investors demand higher yields to hold that option risk. Spreads widen between mortgages and treasuries and lending tightens. Banks and servicers face higher capital and hedging costs. The system still works, but the gears grind louder. There are safety valves already in the code. Some FHA and VA loans are assumable by a new buyer. If a seller has a low fixed rate, you can assume it. You still need to qualify and cover the equity gap. But the payment can drop by hundreds per month. Temporary buydowns can bridge early years when cash is tight. A 2-1 buydown lowers the rate 2 points in year 1 and 1 point in year 2. Builders often fund buydowns because it moves inventory. Permanent points trade cash today for a lower rate for decades. They make sense if you will stay long enough to break even. Adjustable rate mortgages can work if caps are tight and timelines are short. They are risky if you guess wrong on timing or income. Your edge is structure, not crystal balls. By the payment, not the price tag. Compare total monthly across real options on a single sheet. Price the house at different rates and with different buydowns. Add taxes, insurance, and HOA because lenders will. Run the numbers before you fall in love with a kitchen. If you already own a low-rate loan, you have options too. You can keep the house and rent it later if local rules allow. You can watch for a buyer who can assume your loan. You can build equity and wait for better spreads and rates. Patience is a strategy when the market is jammed. Here is the wild part. The 30-year mortgage did not just finance houses. It engineered the American middle class through predictable payments. That same design now concentrates power in the payment. When payments become painful, prices stall no matter the headlines. When payments get relief, demand returns faster than pundits expect. Understand the plumbing and you stop guessing about prices. Master the payment and you win the house. Remember the sequence that still runs the market. Policy created insurance and standards during a crisis. Securitization turned payments into global bonds. Prepayment options made mortgages friendly to families and tricky for investors. Low rates locked millions in place when inflation returned. Now spreads and inventory are the real constraints to watch. So what can you do this year? Hunt listings with assumable FHA or VA loans if you qualify. Ask every builder for buydown quotes and closing credits. Compare permanent points to your break-even timeline. Model a realistic worst-case payment before you bid. Keep a second lender quote ready to squeeze fees and rates. Track local months of supply, not national headlines. Thin supply plus stable jobs equals sticky prices. Rising supply plus weak jobs equals softer prices. Most markets sit somewhere in between and move slowly. Focus on what you can control and ignore the noise. If this showed you how to shrink a mortgage payment and spot real opportunities in a high-rate world, subscribe now.